All right, welcome to this explainer. As tax professionals, CAs, and students, we're literally standing at the threshold of a massive legislative shift. The Income Tax Act 2025 is bringing a total overhaul to how we handle international taxation. Today, we're going to decode one of the absolute most critical areas of this new law, Chapter 13-E, which completely governs the taxation of non-residents and foreign companies. We're going to unpack exactly how these new provisions work and what they mean for your practice.
So picture this scenario, one that a lot of you probably face on a daily basis. A foreign company provides technical services or software to an Indian firm, and boom, they earn a royalty. Under the old 1961 Act, you had to navigate this crazy labyrinth of scattered sections just to figure out the withholding tax, the residency implications, and the audit requirements. So how does this work under the brand new 2025 Act? Well, the answer lies in the streamlined provisions we're about to explore.
Okay, here's our quick roadmap for today. We'll start with an introduction to Chapter 13-E, then hit the legal provisions in Sections 207 and 220, dive into a detailed explanation of residency, walk through a practical example, look at crucial compliance under the 2026 rules, and wrap up with some common practical issues. All right, let's jump straight into our first section, Introduction to Chapter 13-E. If you look back at the old 1961 Act, the rules for non-residents were just scattered everywhere across different chapters. It was bogged down by literally decades of amendments and provisos. Super complex, right? But the new 2025 Act, it takes that exact same tax policy and packages it in a way that actually makes sense. It neatly consolidates these special provisions into Chapter 13-E, specifically spanning Sections 207 through 220. It's a real game changer for ease of doing business, and it brings our tax system right in line with contemporary global standards.
Moving right along to Section 2, the legal provisions, specifically focusing on Sections 207 and 220.
So Section 207 is going to be your primary go-to reference for tax rates on foreign companies. Under the new act, these rates are beautifully standardized. For dividends, we're looking at 20%. But for royalties and fees for technical services, or FTS, the rate is set at a flat 10%. Interest on foreign currency loans is generally 20%, though, it is subject to some specific exemptions depending on the bond or loan. Having these rates clearly codified like this in Section 207 makes calculating that initial tax liability so much easier for foreign entities.
Now, you might be wondering what actually happens when a foreign company triggers residency here in India. Well, that is exactly where Section 220 comes into play. If a foreign company is deemed resident in a given tax year, maybe because their place of effective management, or POM, happens to be in India, it changes the whole shebang. Section 220 dictates how we compute total income, how we treat unabsorbed depreciation, carry forward losses, and it even triggers specific tax avoidance rules. It's a massive shift in the compliance burden the second that residency is triggered.
Next up, Section 3, detailed explanation and the residency transition.
Okay, a term you're going to hear constantly is permanent establishment, or PE. The Act defines this to include a fixed place of business through which the enterprise wholly or partly carries out its business. So why does this matter so much? Because if a foreign company earns royalty or FTS, and that income is effectively connected to a PE in India, it completely shifts how it's taxed. It falls under Section 59 of the new Act, which yanks them into a much stricter audit and compliance framework.
All right, let's talk transition timeline. The old 1961 Act is officially repealed on April 1, 2026. For any tax year starting before that date, residential status is determined entirely by Section 6 of the old Act. And yes, that holds true, even if an assessment notice is issued way after April 2026. The new 2025 Act rules only kick in for tax years beginning on or after April 1, 2026. Basically, Section 536, which is the savings clause of the new Act, makes absolutely sure those earlier years are strictly governed by the old law.
And this brings us to the look-back rule. Now, this is where things get kind of tricky. For a tax year governed by the new 2025 Act, you might have to apply a test that looks at the previous 4 or even 7 years, like the 60 days plus 365 days in 4 preceding years test. The catch here is that you still have to count the days of stay in India during those preceding years, even though those specific years were governed by the old 1961 Act. So, the historical data seamlessly carries over to determine your current residency status. Pretty important detail, right?
All right, let's move to Section 4 and look at a practical taxation example. Let's put this into perspective. Imagine a U.S. company providing technical software to an Indian firm, resulting in a 50 lakh rupee royalty payment.
Now, if that U.S. company has zero presence in India, this is probably just a straightforward withholding scenario under Section 207 at 10%. But what if it turns out the U.S. company actually has a permanent establishment in India and the software provision is connected to that PE? That's when Step 4 kicks in. The income is now taxed under Section 59. This means the non-resident is absolutely required to furnish a specific audit report, certified by an accountant, confirming the income connected to the PE. Let's get into Section 5, Crucial Compliance Requirements under the new IT Rules 2026. So let's map your everyday knowledge to the new 2026 rules. We all know Forms 15CA and 15CB like the back of our hands, right? Well, under the new regime, Form 15CA becomes Form 145. That's your mandatory declaration before remitting funds outside India. The CA certificate, Form 15CB, is now Form 146. And remember that PE audit report we literally just talked about? The old Form 3CE is now Form 24. Finally, for non-resident entities keeping a liaison office, the old Form 49C transitions to Form 162. You're definitely going to want to memorize these new form numbers for your day-to-day practice. Also, we need to talk about treaty benefits and double taxation avoidance agreements, or DTAAs. They require entirely new documentation now. If a non-resident wants to claim DTAA benefits for a lower TDS rate in India, they've got to file Form 41. On the flip side, if an Indian resident needs a tax residency certificate, or TRC, to claim treaty benefits abroad, they file Form 42 under Section 159 of the new Act. Oh, and if anyone needs a certificate from the assessing officer for lower or nil TDS, the old Form 13 application is now done using Form 128. Moving to Section 6, Common Practical Issues and Pitfalls to Watch Out For. All right, let's talk about where things can go really wrong. The first huge pitfall is remitting funds abroad before you've done the mandatory e-filing of Form 145. The rules are super strict here. You must file this declaration before the remittance happens. Second, if you fail to file Form 240 certified by an accountant when a PE exists, that is an instant compliance failure under Section 590. Third, like we discussed, please do not ignore that look-back period. When calculating residency for 2026, you absolutely must count the days spent in India during the 1961 Act years. And lastly, missing the Form 62 annual statement for liaison offices, that can lead to some brutal consequences, including massive penalties under Section 460 and potentially getting your RBI permissions revoked. Finally, Section 7. Let's wrap this up with a quick summary and some key takeaways. So here are the main things you need to remember. First, Chapter 13-E, specifically Sections 207 through 220, is your new consolidated rulebook for non-resident taxation. Section 207 standardizes the tax rate on royalties and FTS at a flat 10%. As for the residency transition, remember that while the new law applies from tax year 2026-27, the look-back rules for calculating days of stay actually bridge both the 1961 and 2025 Acts. Get to know those new forms. 15CA and CB are now 145 and 146, and the PE audit is Form 24. Strict e-filing and audit compliance are absolutely non-negotiable if you want to avoid those hefty new penalties. And with that look-back rule tying the past directly to the future, here's a final thought to leave you with. Are your clients' historical records robust enough to survive a 2026 residency audit? Thank you for watching this explainer. Please like, subscribe, and share. Disclaimer, this explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational explainer.